I'm sure you would have heard that the tax system favors the ultra rich. That is true, but it is not because they have access to secret loopholes. It is because they know what to claim and you do not. Let's change that. In this video, I will give you some advanced tax saving strategies that are not commonly discussed on YouTube. Hi, I'm Armakan. I'm a CPA in Canada who loves to talk about money, investments, and taxes. If you are interested in any of these topics, why not subscribe to the channel? Before we start, you will find all the important links and documents in the description below, including my calculators, other free resources, and links to related videos you may find helpful. There's also a link to connect with me if you would like to work with me and my team. So strategy number 1 is disability tax credit. This is one of the most underused tax credits in Canada, and it is worth thousands of dollars per year. The disability tax credit is a non-refundable credit for people with a severe and prolonged impairment in physical or mental functions. The federal credit alone is worth $10,000 in tax reductions. Some provinces add even more on top. Most people assume that disability means wheelchair or blindness or something extreme. That is not how CRA defines it. You may be able to qualify if you have diabetes that requires daily monitoring. You may qualify if you have ADHD that significantly affects your daily functioning, anxiety, depressions, Crohn's disease, arthritis, chronic pain, autism. All of these can qualify if they significantly restrict your ability to perform basic activities of daily living. The test is whether you are markedly restricted in activities like walking, dressing, feeding yourself, or mental functions like memory, problem solving, and adaptive functioning. The restriction has to be present at all or substantially all of the time. Eligibility depends on severity and functional impact, not just the diagnosis itself. To apply, you need a medical practitioner to fill out a form, which is Form T2201. This can be a doctor, nurse, practitioner, psychologist, or any other qualified professional depending on your condition. If you qualify, you can request adjustments to your previous tax returns going back up to 10 years. I've seen people receive lump sum payments of $15,000 to $20,000 from retroactive claims. If you have a condition that affects your daily life, it is worth checking out. The worst they can say is no. Strategy 2 is related to student loan interest. If you have a Canada student loan or a provincial student loan, the interest you pay is a tax credit. It is a non-refundable credit at the lowest federal rate of 15%, but it still adds up over time. You can only claim interest on government student loans. Private loans, lines of credits, and bank loans do not count even if you use them for education. So for the government student loan, you do not have to claim the interest in the year you paid it. You can carry it forward for up to 5 years and use it when you think it will benefit you the most. If your income is low this year and you are not paying as much tax this year, save the credit for the year when you have more in taxes. Your loan servicer will send you a statement showing you how much interest you paid. Keep that document for your records. One more thing to be aware of: if you work in an eligible profession in a rural or remote community, you may qualify for the Canada Student Loan Forgiveness Program. Certain professions, including doctors, nurses, teachers, and early childhood educators, can get up to $60,000 of their federal student loan forgiven over time, depending on the profession, location, and the number of years worked. I have a full video on that program linked just here and also in the description below. Strategy 3 is related to moving expenses. If you move during the year to start a new job, run a business at a new location, or attend post-secondary school full-time, you can deduct your moving expenses. The key rule here is distance. Your new home must be at least 40 kilometers closer to your new work or school than your old home. CRA measures this by the shortest normal route, not straight line distance. The list of eligible expenses is longer than most people realize. Transportation and storage costs, travel expenses including meals and accommodation, cost of cancelling your old lease, legal fees and land transfer taxes on your new home, even up to $5,000 in cost to sell your old home if you owned it. You can only deduct moving expenses against income earned at the new location. If you moved for a job, you deduct against the employment income. If you moved for school, you deduct against scholarships, bursaries, and research grants. If your moving expenses are higher than your income for the new location, you can carry the unused portion forward to the next year as well. Strategy 4, capital gains strategies and tax loss harvesting. When you sell an investment for more than you paid, you have a capital gain. Only 50% of that gain is taxable at your marginal rate, but there are ways to reduce that even further. Tax loss harvesting is the simplest strategy. If you have investments that have gone down in value, you can sell them to realize a capital loss. That loss can offset any capital gains you have in the same year. If your losses exceed your gains, you can carry the unused losses back 3 years or forward indefinitely differently to offset gains in other years. So let me give you an example. Say you sold some stocks and made $10,000 on capital gains. But if you also had another investment that is down $4,000 from what you paid, if you sell that losing investment before year end, your net capital gain drops to $6,000. You only pay tax on $3,000 because it is 50% of the total capital gain. There is a rule you need to know called the superficial loss rule. If you sell an investment at a loss and buy it back within 30 days, before or after the sale, CRA denies the loss. If you want to stay invested in the same thing, wait for at least 31 days or buy something similar but not identical. This can be one of the audit triggers for CRA covered in this video here. Strategy 5 is related to investment loan interest. If you borrowed money to invest, the interest on that loan may be tax deductible. This applies to margin loans, investment loans, and even loans used to buy rental property. The key requirement is that you borrowed the money with the purpose of earning income from that property. That means investments that pay dividends, interests, or rental income. Capital gains alone do not count for this. If you borrowed money to buy a stock that pays no dividend and your only hope is that it goes up in price, the interest is not tax deductible. Let me give you a real example. Say you took out a loan of $50,000 at 6% interest to buy a dividend paying stock. You pay $3,000 in interest per year. That $3,000 is fully deductible against your income for the year. If you are in a 40% combined tax bracket, that deduction saves you about $1,200 in that tax year. Over time, this grows and becomes significant. This is the same principle that makes rental property interest deductible. You borrowed to acquire an income producing asset, so the interest is a cost of earning that income. CRA looks at the direct use of funds, not your intentions alone. Keep records of what you purchased with that borrowed fund, because if CRA asks, you need to show the money went directly into the income producing investments. Strategy 6 is donating securities directly to the charity. So if you donate to charity, you get a tax credit. But if you donate appreciated securities instead of cash, you get a much better deal. When you donate publicly traded stocks, mutual funds, ETF directly to a registered charity, two things happen. You get a donation tax credit for the full market value of that security that you donated, and you pay zero capital gains tax on that appreciation. So let me show you the difference. Say you have shares worth $10,000 that you originally bought for $4,000. If you sell them and donate the cash, you pay tax on $3,000 of capital gains, which is half of the $6,000 of total gain. At a 40% rate, that is $1,200 in taxes. Then you donate $10,000 and get a credit worth roughly $4,000. Your net benefit in this is about $2,800. But now compare it with this. If you donate the shares directly and you skip the capital gains tax entirely, you get the same $4,000 credit, but you do not pay the $1,200 in taxes. Same donation to the charity, but you keep extra $1,200. Most major charities accept donations of securities. You need to transfer the shares directly to the charity's brokerage account. If you sell first and donate cash, you lose the capital gains advantage here. This strategy works best when you have highly appreciated investments and you were planning to donate anyways. Strategy 7 is related to miscellaneous deductions. There are several smaller deductions that add up over time. Most people miss these because they do not know they exist. Accounting fees related specifically to earning investment or rental income are deductible. If you pay someone to prepare your rental income statements or track your investment portfolio for tax purposes, that is also deductible. Fees paid for investment advice are deductible. If they are paid outside of a registered account, management fees inside an RRSP or TFSA are not deductible. Fees paid for investment advice are deductible if they are paid outside of a registered account like a TFSA or RRSP. Legal fees to collect salary or wages owed to you are deductible. If you had to sue a former employer to get paid, those legal costs can be claimed as well. These are smaller amounts individually, but they add up. Keep track of everything you pay that relates to an earned income. So as I promised earlier, these are some of the hidden strategies that can help you save millions. Obviously, not everyone qualifies for these, but most people never check. If you liked that video, the part 1 of this video is on your screen right now. Check that out, and I will see you in the next one.